Thanks for watching this video. I'm going to sharing about the next step of my calculations like these investments appraisals is about net present value, internet rate of returns, and the paybacks. First is net present values is financial metrics that calculates the present values of all futures uh, cash flow inflow and outflows for the investments discount back to the today's. It's widely used because it accounts for the times value of the money and helps determines whether the projects or investments will add the value. And what is net present values? The definition's net present value is the difference between the net present values of cash inflows and the present value of the cash outflows over a given periods. And cash flow at the times like 0 years, discount back today like cost of capitals or required rate of returns. Interpret it, and if let's say it's like positive net present values, investment is expected to generate more value than its cost. If negative net present values means the investments will likely destroy the value. If says like zero net present values, break evens, no gains or no loss. Now, why use the NPV, the net present values? Because it's considered one of the most reliable methods like investment appraisal because it accounts for the times value of the monies, recognize that the money today is worth more than the same amount in the futures due to the inflations, the interest rates, and the opportunity cost. And we consider the old cash flow, unlike simple methods like payback periods, net present values includes every inflow and outflow across the project life and provide a clear decision rule if the process is like positive net present value, accept the project, negative net present value, reject the project, and allows compares between the projects if useful for capital budgeting when the company must choose between multiple investment opportunity and it's like support the resource allocations. It helps the firms allocate capital to projects that maximize the shareholder values and it's like good tool for the founders and startup for measure the project. And we have some of opinions about like advantage or the limitations of the net present values. For the advantage is you consider the times value of monies, you include all the inflows and the outflows, and you provide the clear accept or reject the rules. Useful for compare the projects, especially for startup or entrepreneur. But the limitation is requires a true cash flow forecast, sensitive to discount rate assumptions. You're not sure your assumptions is correct or not. Let's say like interest rate drop or increase, we don't know. And may undervalue strategic or intangible benefits, complex debts for long-term or uncertain projects. And this is special for corporate finance, evaluate the merger and acquisitions or capital projects, and investment management, assess the securities or venture capitals opportunities, real estate and infrastructures, determine the viability, large-scale developments, and personal finance, deciding on education's investment or property purchase or your retirement plannings. Thank you.